Hey guys, what's up? I'm Erin and welcome back to the channel. Once your retirement plan is in place, how do you know how it will actually hold up? Well, you have to stress test it. Just like a plane gets tested before takeoff, you have to find a way to test it. And here's how. Scenario 1, a market crash. You just retired with a $1 million portfolio. You have your budget, you have a withdrawal strategy, you are feeling confident. But then the market drops 25% in your first year of retirement. All of a sudden, your portfolio balance shrinks to $750,000. You still need to make your $40,000 withdrawal, and all of a sudden, your portfolio balance is $710,000 before the first year is even over. This is sequence of returns risk. The danger of withdrawing during a downturn. The order of returns you capture, especially early on, can make or break your long-term financial plan. But there's a solution. Have a cash buffer. I recommend keeping anywhere from 2 to 5 years of your retirement spending gap in a liquid position, whether that is a high yield savings account or a money market fund, somewhere where it is easily accessible. And when I say your retirement spending gap, I'm referring to the amount you're spending in retirement minus your guaranteed income streams. If you spend $90,000 a year and Social Security covers $60,000, then your gap is $30,000. So a 2 to 5 year buffer would be $60,000 to $150,000, not $450,000, not your entire spending. This buffer really allows your investments to breathe. You're not forced to sell your investments at a loss. And having a cash buffer that you can turn to during market downturns makes your long-term plan far more resilient. I want to zoom out and run a Monte Carlo simulation with these assumptions. Let's say we have a $1 million starting portfolio, a $40,000 needed annual withdrawal, a 30-year retirement, a 7% average annual return with a 15% volatility, and we'll consider 1,000 simulated market paths. The result is in 91.5% of cases, the portfolio lasted 35 years without running out of money. This is a really strong outcome, but it's not a perfect guarantee. We do have 8.5% of RAND scenarios where the portfolio didn't have enough money to sustain a 30-year retirement. And this is why having a cash buffer can be a total game changer. It protects you from having to draw on your investments during incredibly volatile times. It can change the entire risk profile of your portfolio. So if you have this cash buffer, it should move your feeling from I'm probably fine to I'm totally fine. I've got this. What is a Monte Carlo simulation? It's a tool that stress tests your retirement plan against thousands of possible outcomes: good markets, bad markets, crashes, and booms. Instead of assuming a flat 7% rate of return every single year, a Monte Carlo simulation throws in some real-world randomness, and what you get is a probability score. The situations where your portfolio would have succeeded and the situations where it didn't. This is a really great way to test how durable your portfolio is for the long term. If you want to try it for yourself, there's tools like Portfolio Visualizer, Projection Lab, or Merrill's Personal Retirement Calculator, and they can help you run your own simulations. And I'm not endorsing any specific one of these. I just want to throw options out there if you're interested in exploring. Scenario 2, living longer than expected. Longevity is one of the most underestimated risks in retirement planning. Most people retire between the ages of 62 and 65. And here's the thing to keep in mind. Longevity has a way of increasing over time. So if you live to the age of 65, the average man at this point has a life expectancy of about 84. The average woman at the age of 65 has a life expectancy of 87. And many live well into their 90s. That means a retirement that lasts 30 years or more isn't rare, and it's becoming more common. I recently spoke with Bill Bengen, the founder of the 4% Rule, and he said something that stuck with me. If you think your retirement will last 30 years, plan for 40 or even 45. Because running out of money at the age of 92 isn't just stressful, it is absolutely devastating. Sure, at which point you'd probably still have Social Security, but if Social Security doesn't cover all of your expenses, you could be forced to make some really drastic cuts. Plan for 95 or even 100. If you never live that long, it's okay. But if you do, you'll be so glad you planned ahead. This is where delaying Social Security and having a conservative withdrawal plan and making sure you have guaranteed income streams really pays off. Longevity isn't just a blessing, it also comes with challenges, but you can prepare for it. Scenario number 3 is healthcare shock. Healthcare is one of the biggest financial risks in retirement, and it's often overlooked. Even with Medicare, the out-of-pocket costs can be substantial. For the typical 65-year-old couple, it's estimated that over the course of their retirement, they might spend just under $400,000 on healthcare-related expenses. If we break it down by age, it's about $13,000 a year for couples age 65 to 74, about $23,000 a year for couples age 75 to 84, and about $40,000 a year for those aged 85 and older. For many, these could be very real, reoccurring costs. One of the biggest concerns for soon-to-be retirees or retirees is long-term care and who actually needs it. And here's what the data actually shows. For those turning 65 today, it's estimated that about 48% will need some form of paid long-term care, and about 20% of those will need this care for 5 years or longer. If we look at long-term care costs for a private room in a nursing home, it averages about $28,000 a year. For a room with assisted living, it's about $71,000 a year. And for home health aides for 24-hour service, it's up to $288,000 a year. Even if you only need this type of care for a few months or a couple years, it's very easy to see how a serious health issue can put a big hole in an otherwise solid retirement plan. So what can you do? First, let's be honest. Medicare, that doesn't cover everything. And Medicaid, that's means tested. And if you spent a lifetime diligently saving and investing, you have a paid off home, perhaps you have a pension, you're likely not going to qualify unless you spend down the vast majority of your assets. That's really why I believe the most realistic mindset is this. Assume you'll be responsible for much of your healthcare costs in retirement because you probably will. If you're carefully planning a financially sound retirement, that should also include medical costs because it's not just about managing your income and your lifestyle, it's also about anticipating curveballs that aging can throw your way. So here are some things you can do to prepare. Utilize a health savings account. If you're eligible for an HSA, this is one of the most tax-efficient ways to prepare. Consider long-term care insurance. It's certainly not for everyone, and over time, policies have become incredibly expensive, but for the right person, it could be a smart move, so it might be worth something to look into. Have a specific dedicated healthcare savings. Set aside funds specifically for healthcare expenses. Maybe it's for your premiums, the deductibles, dental, vision, hearing, future procedures you may need, or long-term care expenses. Have a fund set aside to cover those. And importantly, have an emergency fund. You always want to have some assets liquid so you're not forced to sell investments in a pinch. When you treat healthcare as a core part of your retirement plan, not a footnote, you give yourself options, flexibility, and peace of mind, because the people who build in that margin are the ones who navigate retirement with true confidence. It's very reasonable to expect that as a household, you could easily spend $100,000 or more on health-related expenses in retirement. It's likely not to come all at once, but over time, it very realistically could come. It might come in the form of deductibles, co-pays, surgeries, or later stage of life long-term care. The point is this: don't be caught off guard. Make healthcare expenses an essential part of your plan. Scenario number 4, an inflation spike. Let's talk about inflation because it is one of the most underestimated risks in retirement. And the thing is, it doesn't show up all at once like a market crash, but over time, It quietly erodes your purchasing power and, importantly, your peace of mind. When you're working, it's easier to handle inflation, especially if you're in a situation where you're having an increase in your pay over time. But when you enter into retirement, the situation is often different. Many retirees live on a fixed income, whether that is a pension, Social Security, and a set withdrawal from their investments. So this can mean that heavy inflation can absolutely squeeze your budget tighter than you imagined. Inflation doesn't hit everything equally, and it often hits hardest the categories that retirees rely on most, like medical care, prescription drugs, housing and utilities, groceries, and transportation. These categories have consistently been among the hardest hit by inflation. A few months at 6 or 8% inflation, that's manageable, but several years in a row, and that's where real damage can happen. Let's look at an example. Let's say you spend $60,000 a year in retirement. If inflation averages 7% for just 3 years, in year 1 you'd be spending $60,000. By year 2, over $64,000. Year 3, nearly $67,000. And by year 4, almost $74,000. In just 4 years' time, your same lifestyle would cost nearly $74,000. That is a 23% increase for the exact same lifestyle. And if your withdrawals or your income are not keeping pace, you are going to be faced with some really tough decisions. Would you withdraw more from your investments, hurting your long-term sustainability, or would you cut back on your lifestyle? Neither is ideal for a stable and enjoyable retirement. Now, it's easy to assume at this time, if you're able to capture a 7% rate of return on your investments, you're breaking even, right? Well, returns don't happen in a straight line, and especially during times of high inflation, we often experience a lot of volatility. Historically speaking, periods of high inflation have come with periods of high volatility, poor market performance, poor bond performance, and just flat or negative returns for portfolios. Case in point, the 1970s. Inflation was over 7%, the markets were choppy, the bond market got hammered, and real returns were lower than many retirees expected. If you retired during this time, it's likely that your portfolio took a beating. Even modest inflation, say 3% per year, has a big impact on your purchasing power over time. Let's say you retire and you're withdrawing $40,000 a year from your portfolio, and you're experiencing standard inflation of about 3% per year. In year 10 of retirement, you'd need about $52,000 to maintain your lifestyle. By year 20, about $70,000. And by year 30, you'd need about $94,000. That is more than double your original withdrawal just to maintain your same lifestyle. Now, of course, there is nuance to this. Many retirees tend to spend less over time in terms of real dollars as they age. Travel slows, entertainment drops, and lifestyles often simplify, especially after the age of 75 or 80. Healthcare costs may increase, but overall discretionary spending tends to decline. Still, this example highlights a key truth that even steady, moderate inflation will erode your purchasing power over time, and a plan that once looked rock solid, if zero adjustments are made, could really be in a bad place 20 or 30 years down the road. So what are the best things you can do to protect yourself against inflation? 1, build flexibility. Make sure you budget for change because every single year is not going to look the same. 2, own inflation-resilient assets. Stocks, real estate, and tips can absolutely help. 3, delay Social Security. This locks in a higher monthly benefit, and cost of living adjustments are based on the benefit you're receiving, so you receive higher cost of living adjustments over time. Next, use a bucket strategy. Segment your assets into short-term, mid-term, and long-term. And it's those long-term assets that you want to capture growth and hedge against inflation. And finally, review regularly. Don't just set it and forget it. Inflation may not grab headlines in the way that, say, a market crash does, but over time, it can absolutely erode your purchasing power. But the good news is you can prepare for it. With smart planning, a flexible approach, assets that protect against inflation, you can go into retirement and live the life that you worked so hard for. As a bonus tip, use the Guardrails approach. Retirement doesn't have to be a fixed, rigid withdrawal approach. In fact, most retirees who allow flexibility into their plan have a more resilient plan, and this is exactly what the Guardrails approach is designed to do. So rather than withdrawing the same amount every single year, a Guardrails approach gives you a spending range. You get a high limit and a low limit, and you withdraw based on how the market is performing. Compared to a fixed withdrawal strategy, like withdrawing a set 4% inflation adjusted every single year, when we look at spending models, the Guardrails approach has shown a greater success rate. And why is that? Because it lets you cut back when the markets are down, and it lets you enjoy spending a little bit more when the markets are up. It helps you prevent yourself from locking in too many losses during those rough years, but it prevents you from overextending yourself during the good years. A flexible strategy means that your portfolio is more likely to last through a 30-plus year retirement because it adapts to the situation. For instance, let's say you have a target withdrawal from your investments of $40,000 a year. With a Guardrail strategy, you build in flexibility by setting two boundaries. You might have an upper guardrail, which is 10% above your target, say $44,000 a year, and a lower guardrail that might be 10% below your target, $36,000 a year. If the market has a strong year, maybe you increase your withdrawal to that $44,000 a year. You get to elevate your lifestyle a little bit, maybe you take an extra trip. But if the market has a poor performing year, you only withdraw by that lower boundary, $36,000 a year, and you cut back your lifestyle a bit. These aren't drastic changes, and they're temporary adjustments that help protect your long-term plan while still supporting a comfortable lifestyle. And remember, your withdrawal likely isn't your only income. Maybe you have a pension or you have Social Security, and that creates a solid income floor, so you don't have to drastically adjust your lifestyle. The key to making the Guardrails approach work is to have an annual reassessment. Every year, review your portfolio balance and spending needs. If your withdrawal hits one of the limits, upper or lower, it triggers a course correction. You raise or lower your withdrawal target for the next year. This strategy was originally formalized by Guyton and Klinger, and studies have shown that over time, especially in volatile markets, it gives greater longevity, sustainability to a portfolio. And one of the really amazing things about it is that over time, even in volatile markets, if you follow a Guardrails approach, many retirees have higher average spending over the course of an entire retirement. And this is because the Guardrails approach really corrects spending in real time, or it responds to true market conditions. So in short, spend more when the markets are strong, pull back when they're not, and stay confident your plan can adapt. It's a flexible strategy that mirrors how real life and real markets actually work. Retirement isn't about perfection, it is about preparation. You want to make sure you can protect your portfolio against all of the real life risks that can and do happen over time. The best plan isn't one that looks great on paper, but one that holds up to the true world that we live in. Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.